We start today's discussions with a great panel lineup that will dive into some detail on the IAIS's holistic framework and give us a real understanding of what it means in terms of effective risk assessment and the steps supervisors and insurers are taking as the framework is implemented in jurisdictions. As with our panels yesterday, we will be undertaking audience polling during this session, so please scan the QR code. There it is. And be ready to answer the questions. With that, I would like to hand over to Chair of the IAIS Implementation and Assessment Committee, Mr. Peter Braumiller, who will lead our discussion. Please.
Thank you, Danko. Good morning, everyone. And we have tough competition with the beach outside, but I hope we will have an interesting and entertaining panel this morning. I would like to welcome four distinguished panelists with me. To my left, we have Clement Jung, who is the CEO of Hong Kong Insurance Authority and also the chair of the IAIS Audit and Risk Committee. Next to him is Andrew Mays, who is the Insurance Commissioner of Connecticut. And then we have Don Ferguson, President and the CEO of the Insurance Bureau of Canada and also President of the Global Federation of Insurance Associations. And last but not least, we have Jane Plunkett, Group Chief Risk Officer of AIA Group Limited. Thank you for joining us here. And as an appetizer, I would suggest that Nicolas will lead us through the main elements of the holistic framework.
Yes, thank you very much, Peter. So indeed, this panel today will focus on the IAIS holistic framework for systemic risk in the insurance sector. And to set the scene, I will briefly explain the three key elements of the framework and the progress that the IAIS has made in implementing these elements since the framework was approved now nearly 3 years ago. So importantly, in light of the finalized holistic framework, now around 3 years ago, the FSB decided to suspend the identification of G-SIIs, or globally systemically important insurers. Now, at the end of this year, the FSB will review the need to either discontinue or re-establish the annual identification of G-SIIs, based on a report from the IAIS on experience with the first 3 years of implementation of the holistic framework. The outcome of this panel will in fact be one of the important inputs to this IAIS report, so we're much looking forward to this. Now, coming to the three elements of the holistic framework. The first key element is the financial stability risk assessment through our so-called global monitoring exercise, or GME. The GME is designed to assess global insurance market trends and developments and to detect a possible buildup of systemic risk in the insurance sector. This includes an annual assessment of potential systemic risk arising both from sector-wide trends, but also the potential concentration of systemic risk at an individual insurer level through our individual insurer monitoring. Importantly, the GME builds on data. Data we collect on the one hand from around 60 of the largest insurance groups for the individual insurer monitoring, and on the other hand from around 30 jurisdictions, which cover more than 90% of global gross written premiums for the sector-wide monitoring. The outcomes of the GME are reported to the FSB every year, as well as to the public through our Global Insurance Market Report, or GMAR, which you can find on our website. In 2020, which was the first year of the GME, we have used the infrastructure to perform a targeted assessment of the impact of COVID-19 on the global insurance sector. Last year, we had a full regular GME covering 2 years of data. And also this year, we plan to have a full regular GME. So that is the first key element of the holistic framework, a risk assessment through our global monitoring exercise. The second key element of the holistic framework is the enhanced set of supervisory policy measures for macroprudential purposes. These policy measures imply enhanced macroprudential supervision and crisis management, supervisory powers of intervention that enable a prompt response when a potential systemic risk is detected, and ongoing supervisory requirements applied to insurers. Now, over the past 3 years, we have further complemented these policy measures with supporting material published in our application papers on the resolution powers and planning, on macroprudential supervision, on liquidity risk management, and on recovery planning. So that's the second key element of the holistic framework, the enhanced supervisory measures for macroprudential supervision. The third and final element is the assessment of the consistent implementation of these enhanced supervisory policy measures across the jurisdictions. This is what we commonly refer to as the implementation assessment. These implementation assessments have proceeded in phases, beginning with a baseline assessment in 2020, which is more of a jurisdictional self-assessment, followed by a targeted, in-depth and on-site verification of the implementation of these supervisory measures across the 10 major jurisdictions over last year and this year through our so-called targeted jurisdictional assessments, or TJAs. Also, the outcomes of the implementation assessment will be reported to the FSB as well as to the public early next year. So that's the third and the final element of the holistic framework. And with that, Peter, I hand you back the floor and I wish you a great panel.
Thank you very much, Nicolas, for putting what is quite a comprehensive framework into a short and clear description. Initially, and may I say so, that the whole framework is not just a framework, as you have heard, it's just also a process that is repeated on an annual basis. And we try, I think it would be best in our panel to try to follow the sequence of first, what are the risks, so the input to the monitoring exercise, then what about the monitoring exercise, and then to talk about the consequences and what we learn from that. Let's start with the risks, and we have a polling question because we will then see what your view is, and the polling question, I hope that it be displayed there, would be which issues currently pose the greatest risk to the financial stability of the global insurance sector, and then you can choose climate risk, credit risk, cyber risk, inflationary pressures, interest rate risk, liquidity risk, and other. And while you are considering what you think they are, I would start our panel with asking a question about the risks and asking, what do you think are the three risks you are tracking, the top three risks you are tracking in the insurance sector? And more importantly as well, do you think they are more regional type of risks or they are more even global type of risks? Because it's exactly what the input should be for the global monitoring exercise. Clement, may I ask you?
Thank you, and good morning, everybody. As you know, I'm a supervisor, so I have a bad tendency of choosing all of them. And but I've been told I have a big job in my hands, because if my answer is not interesting, I'm going to jeopardize the rest of this panel. So I tend to answer it in a slightly different way. My choices are inflationary pressure, interest rate risk, and climate, and they are not the only ones, of course, but they loom largest on my horizon, and I think they are all globally and regionally important. I tell you why, and try to be brief, Peter. Now, as you know, we have seen on Wednesday a 75 basis point of interest rate upward adjustment by the Fed. I was told that, in fact, it's the largest in almost 30 years, and there are expectations of more to come. Now, in inflationary pressure and interest rate risk, I believe affect insurers in some common areas, for example, like the long-term claims liabilities, which in turn impact on reserves, operational costs, and also the asset liability management. I think you all know that. I don't need to repeat it. But in the Hong Kong case, the inflation and interest rate are somewhat tied together. Not least because we are running a currency board system which is pegged to the US dollar, which started and operated well since 1984. Now, that means that when the Fed increased rate, it creates pressure on Hong Kong to follow suit, because there will be carry trade between the two currencies. Now, that is not yet giving an impact, but is already shrinking the liquidity base of our currency board system. If that happens, the upward pressure on interest rate will affect macroeconomic environment. And that hits us at exactly the wrong time, because we are actually trying to start recovering from COVID. Now, that is a major issue. In the life sector, it's going to affect people's affordability for insurance, where they really need them. And it also increase, as I said, the operating cost of insurers. Now, so that is an issue which I won't elaborate, but later on we'll have to see how we tackle that, because we do not want the market to be not able to follow the trend of recovery from COVID. Now, on the non-life sector, it's more interesting. In case you're not aware, I have a very interesting market. I have 2/3 of my insurers operating in the property and casualty sector, which takes up only 10% of the market share of premiums. So it's a very crowded space, and they compete fiercely. And I also have an economy where 99% of companies are SMEs, very much underinsured. So the inflationary pressure and interest rate pressure is going to hit at a protection gap, which is widening at the time when they are not able to cope. So less demand, but yet you're facing a widening gap because of inflation. So it's a double whammy. So I'll stop at that, Peter. I hope to have a chance to come back to it later on.
Sure. Andrew, if you cannot choose all of them, what is your
I can't? Okay,
choice?
all right. Thanks, Peter. I'm going to go with my top 3 risks. I'm going to start off, and this is in no particular order, but as I look at it, cyber risk, because it is integral to the coverage that companies need in today's markets. I've got a couple of the big cyber risk writers as domestics, and I see cyber as both operational risk and an underwriting risk. Now, part of the issue with cyber to me is simply the lack of history. You know, the last time we went in and had a product that had as little history as cyber, we called it long-term care insurance in the US. And we know that there were significant pricing problems that developed later. And that's part of my concern as I look at cyber. We're starting off and we're not entirely sure, given the lack of history, that the coverage is properly priced. I've called in my domestics. As I mentioned, we've got some of the domestics who write lots of the cyber coverage in the US and internationally as well. And we've had a discussion, numerous discussions, as to the way they see the market and the way they see their roles. And the good news, because part of this, part of the question with risk is not simply the risk, but the opportunity, is that these companies don't necessarily see themselves as just providing the coverage, but they see themselves as helping their clients become resilient and both prevent and mitigate damages. And that's what I think is very important about cyber insurance as a product. It is hardening our society, certainly in turbulent socioeconomic and geopolitical times such as these. It makes it even more important than ever that that insurance companies, in essence, become agents of change, that they're able to reach out there and keep the companies they provide coverage to operating, not necessarily without concern, but certainly operating and able to deal with whatever attacks they may face, as we know they will. Another issue that I had with cyber was silent coverage. That was something that I think we've managed to address for the most part. I did have a significant concern that there was coverage that was simply assumed as part of a policy that had not explicitly been prohibited. The good news is that many of these companies, I would say certainly for us, all our companies, are moving or have moved to explicit cyber coverage. So we are not going to see the same kind of issues that we saw with business interruption insurance, for instance, where people thought they were covered, they weren't. There was significant reputational damage, and an awful lot of this ended up in court. There is, of course, the operational risk for the companies themselves. Insurance companies have a reputation, and if they get hacked, and they are targets because they're huge repositories of information, they have to be sure that their systems are strong, are robust, are designed to repel invaders. So overall, cyber risk, as I mentioned, it's both an operational and an underwriting risk. It's constantly evolving. And with cyber coverage, the one other thing that I need to add is the idea of a moral hazard. Certainly that's a concern that many have by providing cyber insurance. Are we encouraging cyber criminals? Frankly, that's an interesting philosophical question. but I don't see that we have a choice. This is coverage that we have to provide in order to keep society going. Moving along from cyber risk, I'd go to climate risk. It's nice and toasty warm outside today, as usual. I'm not a big fan of heat, as you can tell. But in Connecticut, for example, we have the second highest percentage of insured property along the coast and subject to climate change as any state in the US. Only Florida has a higher percentage. And we are concerned. We need to make sure that the issue is addressed holistically. And we have to make sure that our insurers are doing their part, both in terms of the investments. It's an investment risk in terms of the investments that you're making. What you're doing now, are there risks that you are not fully disclosing or bearing, or fully disclosing, I should say. That's part of what we're looking at, and like I said, climate risk. What we're doing with the TCFD, the Task Force for Climate-Related Financial Disclosure. Certainly, we've moved at the NAIC over the past decade and a half. We've moved towards greater disclosure. We are moving now towards standardization by using the TCFD template that is modified to reflect the particular needs of insurers. We need to make sure that insurers, and I say this all the time to insurance companies, I'm not your chief investment officer, I'm not your chief financial officer. I am not here to tell you where to invest. But I am here to make sure that you are cognizant of the risks, that the people who are buying from you are aware of the risk that you have, and that going forward, your investments are properly positioned to reflect the payments that you are going to have to make to that grandmother who bought a life insurance policy for her child that probably will not pay out for another 70 or 80 years. And I think it's, climate change is an existential risk, and we need to treat it as such. One emerging issue with climate risk that I see, we had a conference last year, the Connecticut Conference on Climate Change and Insurance, C4I. And one of the speakers we had was from the Yale Center for Climate Change. And she was talking not about the physical risk as we usually think of them, or the transition risk. She was talking about the current risk to life and health. We've seen the impact of climate risk and that's spread across our society, but certainly within the United States, we've seen it focused on those least able to address it. And there are two ways, that's not just in terms of the places where they live, but it is in terms of the effect on their health. We've seen disease patterns change. We've seen heat stress changes. And we need to be able to make sure that the populations that we serve are being properly served, that underserved populations aren't subject to a discriminatory effect from this, whether it is from the climate changes itself or from the insurance, be it life, health, or property casualty that we provide. And speaking of disproportionate impact, speaking of possible consequences on those who are least able to afford it, I'm going to move on to number 3, and it's not on there, but it's big data. We live in a society where there is more data available than ever before, and more ability, more opportunity, but also more ability to manage that data. Now, we have a number of baseline questions that we have yet as a society to truly answer. One of the most important is, whose data is it? But from my side, as a regulator, I want to make sure that the data that you're getting is accurate, that the data that you're getting and the way you're using it is not discriminatory. I think big data and the corollary, AI, machine learning, all the technology that can drive innovation could be a vast force for good for this industry and for society. It could enable us to reach sectors of society who have not been able to get, have not been able to afford, have not been able to understand the needs for our products. So I see it overall as a great thing, but I want to make sure it's done right. What we cannot afford is unintended consequences. What we cannot afford is a lack of transparency. What we cannot afford is consumers losing trust in the system. I mean, this big data and AI in general has so much to offer. I want to make sure that our industry is able to properly use it. And this is, whether it's dealing with climate change or with others, I just think the innovation that can flow from this can be such a positive. So it's not on the list, but I wanted to bring that up because it is a big risk if we do it wrong. But if we do it right, it can provide one of the greatest opportunities for growth and for consumer protection that we've had in quite some time. Back to you,
Thanks, Andrew. That's why we put other, and that might cover a lot. And thank you for elaborating one that is certainly under the other and might be move up the list as an extra point. Don, how do you see it?
Thank you, Peter, and thanks to the IAS for the invitation. And good morning, everyone. As I was bedding down last night, there was an awful noise coming up from the water area, and there were a lot of people all jumping up and down at the same time. And I suspect many of you were part of that group, and so good for you for being here bright and early this morning. And thank you for stopping at about 10:15 or 10:30. So I had a good night's sleep as a result.
Is that already a risk? Or
that was a risk for me. If I had gone down, that would have been a risk for me, not on the list. I'll just try and add a little bit to what's already been said and what was said yesterday about some of the risks that are on here. So on the macro economic environment, the war in Ukraine, pressures still from COVID, kind of the second order pressures that we're all feeling. Inflation, as has already been mentioned, market volatility. I've given up looking at the market day after day over the last several weeks. Interest rates have gone up. I know in the last GMAR report that was cited. So this, it's a blessing, but maybe a curse as well, as we've heard. So that continues, and many of these are global. This is certainly from a regional point of view felt back in Canada the way that it is in many other parts of the world. But the industry has had a tremendous track record of dealing with crisis. Whether it was the 07, 09 crisis, we came through that exceptionally well. The IAS has said in numerous reports that we're a stabilizing influence on the financial sector, and I think we always have been. I want to believe that we will continue to be. During COVID, Vicky, I think, famously said that we were a shock taker, not a shock maker through the early days and through most of COVID. So the industry, has been that stabilizing force. I believe it will continue. Should we be concerned? Absolutely. How could you not be concerned with what's happening? When you're hearing about 75 basis points increases, we absolutely need to continue to be concerned. Do we need to be vigilant? Absolutely. We regulators, insurers, all need to be vigilant. But I think it's important that we don't overstate the potential for systemic impact on the sector, because it has been such a stabilizing influence. Not much that I can add to cyber that hasn't already been said. Andrew had some comments. I listened to the panel yesterday. I walked away terribly depressed and petrified about opening my computer when I got back to the room, figuring something was lurking behind it. But and Andrew, I think, characterized it well in terms of the race to protect ourselves as an industry, and I think a lot of good work has been done with regulators on our own, whether it's third-party suppliers, our own cyber defenses that insurers have had to put up. I think we've done an excellent job to date. Much more has to be done there. But if we're racing to protect ourselves, I think we're kind of walking towards protecting others, and I think it's a cautious walk for many of the reasons that was mentioned yesterday, and Andrew touched on some of these. And it comes back, for me anyway, to this insurance gap, which I want to raise just in the context of my third item, which is climate. And as Andrew said, not just the climate in the room here today. So I'm from Canada, not a land known for heat. But last summer, a little town called Lytton, British Columbia, on the far west coast of Canada, hit a temperature of 49.5 degrees Celsius. We had 600 people die over a period of a couple of weeks in British Columbia. And I've said this publicly, I don't know how many times now, and every time I say it, it still puts a shiver up my spine. The 600 people died as a result of this heat wave. The next day, after hitting this, a fire broke out in this little town of about, I think, 2,000 people, and the entire town was destroyed. There was not one building left standing. And that's in Canada. There are other parts of the world, obviously, much harder hit by climate change, but we're all being affected by it. Once again, our industry has been that stabilizing influence. We were there for people through COVID. We had some of our worst natural disasters in Canada during COVID. Claims were paid, customers were serviced, and our industry played its role. My concern on the climate file, and I know we're not here to talk about protection gap issues, but my concern on the climate file, as it is on cyber, as it is on retirement and a few others, is the protection gap, is the role that we're currently playing. Andrew touched on this a little bit. Can we continue to play that role as an industry going forward? I realize that's a little off topic when we're talking about the holistic framework, but for me, when I think of climate, that's one of the first things that come to mind. I'll pause there, Peter.
Thank you very much, Don. And I think there is this close link between the protection gap and in order to try to solve the issue, you need to understand what is the risk and what do we know and what can we do. And I like very much that we start with that to say, yes, what are the risks? What are the conditions under which the risks can be covered before saying, yes, it should be the public, it should be the private sector, whoever. Let's turn to Jane then.
Yeah, thank you very much, and thank you to the IIS for inviting me. It's a pleasure to be here. So I'll try to bring you a bit the company perspective on these topics. I work for AIA. We're a large, predominantly life insurance company that operates in 18 jurisdictions across Asia. So we have a regional lens, but also a global lens because obviously we're trading in different currencies and particularly impacted by US dollar changes. We operate across these markets with 39 million individual customers and 16 million group customers, and we have agents and, of course, the assets to support all of that. So it just gives you the backdrop of the kind of risk landscape that we manage at AIA. And I think when I look at the risk landscape, it's about this question of is it local or is it global or is it regional? For me, it's all of those things. A bit like Clement said, I'm tempted to say all of them because we're managing all those risks on a daily basis. But from a group perspective, what I always think about is two things. So first of all, small risks that have the opportunity to become large, and then large risks that affect the group. And mainly, it's my job to make sure that we're prepared and we're resilient when those risks come because we're a risk taker. We're an insurance company, and that's what we do. So we have to have the right frameworks in place. We have to have the right resilience so that we can face those risks when they come. So that brings me to the answer, and I'll also answer it probably a bit differently than the list here. But first, the first area I always think about is the macroeconomic side. Of course, we're a life insurance company, so we're impacted by all the forces of the markets. But the most interesting thing to me is really the impact that not not the direct impact necessarily of some of the economic indicators that you see, but also the second order effects. I think you mentioned this already. If you take the example of the Ukraine-Russia situation, it's easy as a company to say we have very little direct exposure to that situation. But the second order effect is affecting all companies that operate in a global marketplace. So I think as risk managers, we always have to think about the second order effect of all these things that we see around the economic landscape. But of course, interest rate risk is the biggest risk that we manage in a life insurance company. So I can't say that it's not number one on this list. The second area, if I turn to more operational aspects, I would call it technology risk. Because it's really easy to talk about cyber, but I think technology in general presents many risks, but also many risk mitigations for us as a business. So we can talk all day about the risks of cyber and hacking and everything else, but at the same time, it also helps us to automate things, streamline things, and put automated controls in place where we didn't have them before. And then the third area, which is not on this list at all, but I thought we could bring in a bit, and it maybe isn't rising to the level of financial stability of the global insurance market, but it might be, which is the risk of people or human capital. Because we're a growing company. So we're hiring agents all around Asia. We're hiring employees all around Asia. We need different skills than we've needed throughout the years in the past. And so this all leads to being able to get the right number of people with the right skills in the right place. And that's not always an easy thing to do. And so I think you might think of it in terms of our company's resource properly, but I think about it as people risk and how do we manage the human talent that we have within our organization to make sure that we can carry out all of the ambitious goals that we have. So I think it's a risk we shouldn't forget about.
Thank you very much. So what we just have heard would be excellent input for the GME, for the discussion we have in the process, if we just try to mirror what is the process in the holistic framework. Let's just see the results of our polling. Yeah. Any reaction from the panelists on that? Yeah, Clement?
Well, what can I say? I got all three right. No rewards, I'm afraid. Yeah. But that tells you something. So which I think we're going very soon to the second round of questions. But what I need to emphasize again is 2 points. First is that global and regional and jurisdictional risk are very much connected. You just need to find the nexus. Second, I think it's that the holistic framework, in fact, is trying to cope with that. And I will leave you with the remark Don just said. Don said something when he talked about cyber risk. He said it's a bit off the holistic framework. I do not agree with that. In fact, it's got everything to do with the holistic framework. I think the next question, Peter can move on to how that works.
Exactly. And I think when I was listening, I was also thinking about sometimes we shouldn't speak about global risks, but risks that could have global impact would be rather more the appropriate term. So when we get that, so that would be the process, and then we have all this input, and then we discuss it in the GME, so as we have heard from Nicolas. And so I want to ask the question maybe first, because it's first an internal process, of course, among supervisors within the IS. So let me first ask our supervisors to what extent you think that the whole GME process is helpful to you, and what benefits you seen from the process at the international, but also at your jurisdictional level.
Thank you, Peter. Since I'm next some time just now, so I'll be very brief. And as I said, I think the holistic framework, all the elements are immensely important to bring the global and local, regional aspects together. Now, we are focusing specifically on the GME, so I'll just speak on that. I think in a nutshell, it brings in both global and regional jurisdictional alignment. I say that because the GME is structured in a way that allowed us to focus on individual insurers, those who meet certain criteria In the case of Hong Kong, Jane is actually working on one of them. We've got 2 IIGs, the third one coming very close on the horizon. So the IIM provides us with an excellent platform to try to look at the systemic importance, the footprint, and the inherent risks. But the interesting thing is that it provides a platform where the groups themselves will be aligned. When we try to supervise them in the old days without this particular platform, there tends to be pushbacks. Well, you must be very familiar with that word, but they push back for different reasons. But I dare to say, I don't say it because I'm IIS ExCom member, I must emphasize, is that with the platform of the IIM, they tend to, at certain times, compete because they wanted to make sure it provides the best input to the satisfaction of the supervisor. It happens most of the time, I'm afraid. Sometimes we do have some fights, but then that is quite a useful tool for us. Now, I mentioned earlier at my first answer that we have a very fragmented market. I have over 160 insurers, as I said, 2/3 competing in a very tight space. So the second layer is about the global monitoring exercise. It provided us with a global linkage whereby we can then do a much more granular and refined assessment on those smaller insurers, which otherwise will not be fronting up on the radar screen because they are not big enough. But as Jane said, the risks lurking behind the corner are the risks that aggregate and hit you while you're not really prepared for it. So the sector-wide monitoring gives me that tool. It also allowed me to try to align my internal organizational structure, the teams to start working with that particular focus. So there is an internal alignment. And on the regional perspective, we also have the Supervisory College, which again, will be able to benefit from the GME. So the discussion at the Supervisory College also has a very good focus. And therefore, as I said, Peter, my answer is tremendously useful. I have been using it for the last couple of years. I speak from experience. And this global alignment together with local and regional alignment carries tremendous benefits for me as a supervisor.
Thank you, Andrew.
I would echo everything that's been said there. Yeah, the discussion that goes on during the GME, for instance, this is vital to not just the IAIS, giving it a better understanding of the emerging risk and to the development of better tools to deal with that risk, but also to us as local supervisors, as local regulators. Here at the NEIC, we have a financial stability task force, which is charged with looking at macroprudential issues, and part of the way it does that is by looping into what happens here. And it is that feedback loop that is important, that we get information not just from companies, but from the IIS, from peers across the world. And there are ideas that perhaps we may not have thought of ourselves that become apparent. There are risks that we may not have seen or that may not be obvious to us as yet that we can start looking out for. I think overall, the holistic framework has proven itself, especially if you look back over the past couple of years. You see the flexibility that it affords. This is not a rigid system. It's a system that allows us as regulators and supervisors to address the world as it is. And the world as it is filled with items like pandemics that pop up when you least expect them. So for us, it's given us, certainly for us in the United States, it's given us more tools. It's given us more communication. It has positioned us better to address and to mitigate the effects of systemic risk. And I think that was the goal to begin with. I think it's young, it's new, but so far I would definitely say it's succeeding.
Thank you, Mapi. It's a point in time to say we have now heard that the these two elements, and both Clement and Andrew have worked it out. The old GSI identification process was just focusing on the groups, on the companies, and that is, I think, the extreme value added we have in the holistic framework, because we understand that risks can not only come up through different groups, but they can build up in the whole sector. And so let's have a polling question before I turn to Don and Jane again on where do you think is most likely that systemic risks and possible spillover effects for the rest of the financial system might come from? Do you think more the risk within a single large insurance company or group, the risks across the insurance sector, or a combination of both, or any other? We always have other because we are prudent people, so we don't know what else could be. May I turn now to Don and Jane about what you can, of course, see is the GIMA, the Global Insurance Market Report, as an output of the GME, of the discussion, both on the individual side and the sector-wide side. So how useful is that for you? But what does it tell you? And do you think that supervisors have really similar views, or are there any differences on their perspective on risks? Might be not the risk itself also, but the nuancing, the focusing. So how do you estimate that? Might be Jane, can you go first?
Yeah, I'm happy to go first. So first of all, in terms of the risks that are monitored and the risks that they're measured through GME, they're not different than the risks we look at. So I think you would expect that, right? So these are the same risks that we're looking at from a company basis, and that we're looking at across all of our different businesses within our company. In terms of the report, I think we find it very helpful to be able to see sort of what it looks like, what the risk landscape looks like across different sectors. I mean, we don't consider ourselves as an entity to be systemically risky, but we also want to make sure that there aren't other systemic risks lurking out there in an industry that we're part of. So I think for us, it's a very helpful tool in terms of seeing what's happening throughout the industry. It's a window we don't always have because we're focused on our own company. And so it's very helpful to read the report and see what both supervisors are saying, but also the assessment that you're making on the industry and on companies within it.
Thank you. Don?
So many years ago, I worked with a colleague, and his life philosophy was what interests my boss fascinates me. And if there are any young people in the audience, it's a great philosophy. It'll keep you safe at work for years to come. And so, if my bosses are interested in this, then I am absolutely fascinated by it. And paying, as Jane said, and paying attention to it. So we absolutely do, Peter, pay attention. I mean, I think the GME is a fantastic tool. The quality of the data, is exceptional. The outputs, the last GMAR report, who could quibble with the 3 or 4 issues that had been identified there? I think it helps us. It provides some guidance for the discussions, as Clement said, that are ongoing between the regulated entities and regulators, between policymakers and associations like JAFIA or my own association back in Canada. So incredibly useful, incredibly helpful, good communication back and forth. I mentioned this yesterday in the question I asked during the town hall. Good communication often leads to good results, and certainly there will at least then be clarity in terms of what both sides are seeing, and there is good alignment between what keeps our regulators up at night and what Jane and her colleagues are focused on during the day. There's good alignment there. Not to end on a down note, but and my team always says this, Don, you should never end on a down note. But I do have to put a caution out with respect to data, just the demands on our sector. I'll come to this a little bit later when we talk about changes we've seen in our own jurisdictions in terms of macro-prudential regulation, but the demands on member companies, on insurers, and on trade associations like mine 4 consultations, short timelines, heavy data calls. I realize you cannot do your job, regulators cannot do their job without the data, without good quality data and a certain amount of data. But I guess the request is just to be mindful of that the demands are heavy, they're increasing all the time, and it's something that we hear from our members, from organizations like Jane's and others, that the demands can be excessive. So just a caution.
Good. Well noted. So I think there is a dialogue always ongoing, because we don't look. So certainly it's often the case we have kind of emerging risks where the data situation is not as good, but we also see that sometimes we have a qualitative way of trying to get information, or we try to, but we'll put a lot of emphasis on the quality of data, just more than the quantity. So let's see what the result was here. Yeah. And I think we have a clear vote in favor of the holistic framework, because that is exactly the elements that it is in there. So the risk is on anything else. So it's a vote also against a pure view on an entity approach, entity-based approach. It's only 3%. So that is good, and hope the FSB will have a similar view at the end of the year based on what we will report to them. Let's now go to another round of questions. And now we have seen, I think, the differences there were not so much about real the risks, they are more nuanced about the regions, about whether there is life or non-life, or what is the predominant sector, and these type of things. So my next polling question would be to you, and my last one for this panel would be what risk pose the biggest threat to the financial stability for insurers in your jurisdiction? So we are now moving on the impact side and saying, do they come from domestic risks, more from kind of regional risks, so faced in the whole region more, or is it really global risks, so global macroeconomic or whatever, global climate risk or whatsoever? So where do you think that? And while you get your mind around this, I would start another round of questions to my panelists. To all of you, I think we have a lot of lessons learned, and we have gone through a process as regards this risk identification, what we can do, and what is systemic and what is not systemic over the last few years. What are your conclusions, and about the most effective way to manage potentially systemic risk in the insurance sector? So let me start with Andrew first. Maybe I'll need to change a little bit the order.
Thanks, Peter. I'm not necessarily sure this is the question that you're asking, but this is the answer that I like giving, the holistic framework.
Yeah. Thank you. That's why I asked you first, and thank you for that.
I think we've seen that switch over the past 2-3 years, as Peter mentioned. I think it's in November this year, the FSB will decide whether to move from the GSI-based approach to our holistic framework. And as I mentioned earlier, I think the holistic framework has shown over the past 2 to 3 years that it works, that it provides a flexibility that we need, that it provides the information that we need, that it provides us as regulators and you as industry with the tools and with the knowledge, with a certain commonality, so we know what risks are coming and how best to address them. It certainly worked well for us as regulators in the U.S. Yeah, there is no doubt that size does matter in certain cases, but to us, we feel, and clearly the holistic approach says, that what is more important than size is activity. And as we've implemented our own version in the U.S. on our macroprudential initiative, we've looked at different things. One of them is, just to pick a couple, the liquidity stress testing for life insurers, for instance. We've implemented sorry for all the data calls, but we have implemented an in-depth look at that part of the life insurance sector. And we are doing liquidity stress tests to ensure that the sector does not and will not pose a systemic risk. That's part of what we look at. That is part to us, a part of the holistic framework. And it's not just the fact that we're looking at life insurers. It's also the fact that we are looking at smaller life insurers that may not have been caught under this huge, 8 or 9 G size under that process, but could perhaps pose a greater systemic risk than the larger insurers with more mature risk management systems. We want to be sure that we catch the activity, that we examine the activity, that we know what may or may not pose a systemic risk. A couple of the other items, just to throw them out here, just pension risk transfers. We've got a large and growing industry in the U.S. of pension risk transfers. We used to have lots of defined benefit plans that companies did. So the biggest companies in the world, all the way down to your small, regular companies, everybody expects to get their pension when they leave their job. It's expensive, and certainly it has not been profitable for many companies to do. And we have, in essence, almost that whole new industry now because of its size of pension risk transfers. Does that pose a threat to the economy? Does that pose a possible systemic threat? That's one of the things we're looking at. Private equity ownership. Certainly in Connecticut, we have a number of owners of insurance companies that are private equity firms or similar. And when they do what we call a Form A, which is part of the ownership transition process, there are questions that we are going to ask. For instance, one basic question is, what's your investment horizon? We're not looking at companies that are planning on coming in and just flipping a company a couple of years later. We want to make sure that your management is in sync with what we think the management of an insurance company should be. That's that's one item that we look at, but there are other items. What are the fees for your affiliated transfers and so much more. But a framework like this, a framework that allows us to respond both to externalities and jurisdictionally to what is important to each jurisdiction, is, I think, so much better overall and has the potential to be so much more effective than a large, much more rigid framework based solely on size. So I'm going with a holistic framework. I was talking to somebody yesterday who said they didn't like the word holistic. Everybody uses holistic. You come up with a different word if you can, but I think the framework's great. Peter?
Thank you. I think the idea was really to make a sharp difference to the existing system, because the GSI element is still there, but it is just one of the overall elements. And you're right, because when I remember the old days, and I was the guilty one who was there when in 2009, 2010 we started to develop that. But it was clear that was the first step, and I always remember this was the first step. We need to develop it further. That was clear at that point in time. I think the definition of the FSB, if I correctly remember, was this disruption of the global financial system through, and then it was institutions, products, or markets. So, and if you focus on institutions, you might not even get. So it's even in the very, very first. I don't know from where it comes, from 2009 or whatever. To meet this definition, you must look at this. And as I say, Peter, if you break up this IAG or this GSI in 3 different entities, they no longer meet the criteria, but still the risk is there because that is counted for the whole market. Who wants to go next on?
Clement?
Clement first. Yeah.
Okay, I'll be quick. Thank you, Peter, for not directing that question to me, so I can think about an answer when this guy is trying to get you entertained. But I think the crux of the issue is, how do you define systemic risks? For me, I just riding on what has been said before, I think the biggest risk is the risk that you do not perceive as risks. So the whole essence of, I believe, the comparison between entity level and activity level captures that very well. Both are complementary, both are important, but if you can't see all the risk, that's where the biggest peril is. And Peter, you mentioned about the origin of the holistic framework. I think it came from the global financial crisis. You're right, 2009. But I think there's one very important difference between the GSI and what we have now, is because insurers are not like banks. We don't have 160 banks operating in a very tight space like us. So the interconnectedness between insurers are also a lot less. So we got to recognize that the insurance industry, although it's affected in the same way by the global financial crisis, the transfer and the contingent of risks and the nature of risks are inherently different. So the holistic framework attempts to capture that. And to just add on what Andy has been saying, apart from these global alignment and regional local alignment I talked about, this extra layer of additional flavor like private equity, climate, cyber, all the things you see in the first slide will add a lot of extra dimensions to every single exercise that we do. So that adds to the efficacy of the system. And finally, we should conclude with one point that raised by Don. I agree. We cannot be avaricious about data because there's never enough of it. What we try to do in our case is that we try to build our supervisory framework around what is already being prescribed by the IIS, and therefore I will reduce the additional burden on insurers, and therefore I think that creates a what we call a virtuous circle whereby people will be more willing to do it because they know that by doing more on the GME, they will probably hope to get less from us. So I think that works quite well for me.
Thank you, Clement. And I think it was worthwhile to understand that this risk identification issue is quite important. That's why my first question was all about let's think about, and I was very happy that under the other a lot came up, and I'm pretty sure if we are 10 people here, more comes up. And if you name it, and then you can still discuss whether what is, and then you can measure it and mitigate it as the next steps. But I think this risk identification, this is, I think, a strong part of that if you collect all the experience and all the situation in different markets. Don.
Okay, thanks.
Particularly about this entity and this new approach we have now.
Absolutely. And thank you, Clement. My work is done here this morning, ladies and gentlemen. Clement is I'm speechless now. I don't know what to say. No, I appreciate the comments, Clement. So the holistic framework, for me, is something of a new thing. And we just have, in Canada, last year, our first IAIG. We never had one before. So paying attention in detail to the development and the implementation of the framework was not top of mind for me. So over the last couple of months in preparation for this, I did a deeper dive into the origins of the framework, how people feel about it, and I kept coming back to the phrase uncommon common sense, and that to me is what this framework is dripping with, which is just common sense. It's just, why wouldn't you approach an issue like systemic risk in this way? Right, and so kudos to the IAS for developing, I think, a brilliant framework. We have a term that we use in Canada when we're trying to solve certain problems, to go back to the naming, the holistic framework. So we're trying to develop a national flood program in Canada, and we talk about a whole of society solution. So this might be a whole of industry framework as opposed to holistic. But the way that you've included all the stakeholders, risk identification, good process, good communications, I think there would be a strong level of support. And not seeing the G size come back, I don't think will disappoint anybody on either side of this issue. Once again, the issue of data and proportionality from our members comes to mind, that our sector is traditionally stable. As I mentioned in my opening remarks, that the IS sees us as a force of stability. Having that at the back of our minds as we implement this, and as we go out and do risk assessment, risk analysis, and so on, having this principle of proportionality in mind, I think would be one message that I would want to leave.
Thank you, Don. Jane?
I guess I would just pick up on this this word you just used, common sense, and I echo the views here. I think the framework is full of a lot of common sense, which is really what we do, right? In general, when we're managing risk, we always start with having the right frameworks, the right thresholds, all the right boundary conditions in place. Then we do monitoring of all those risks, which is similar to what we do through the GME. And I confirm that we always appreciate that the data collection exercise is not extra. I mean, for us, from a Hong Kong perspective, as Clement said, it's aligned. So that makes it much more efficient for us as a company. But I would bring in this last point about the execution, when something needs to be done. Because I think we can put all the frameworks in place, we can do all the monitoring, but when something big or small needs to be done, that's when it really matters. And that's when you test the frameworks and you test the monitoring. And so I think that's also an important point that we discuss here is, what makes good outcomes in times of small or large crises. And I think it's a number of things. It's being prepared, having those frameworks, having the monitoring tools, but it's also being able to take decisions quickly when you need to. And certainly that happens within a company, within the management and with the board of directors. But I think equally important is the line of communication with regulators when something happens. And that can be a crisis, or it can be something like what we experienced as an example during COVID. So, face-to-face sales are critical to the life insurance industry across Asia. And if we can't do face-to-face sales, then that hurts, all the companies in the industry. And we had quite a positive experience, I think, working with all of our regulators across the regions that we operate in being able to have non-face-to-face sales during that period. Some operated in terms of a sandbox, others implemented temporary measures, but overall it really helped the industry, and more importantly, it helped the consumers, because they could continue to buy protection products, they could continue to protect their families and their assets even during that time. So I think this dialogue and this important relationship, it's not always easy, but this relationship between us is really important in order to sort out things that happen, when they happen, because we can't avoid all the risks of the world. So from time to time, we will have to have a dialogue about how to solve certain things.
Thank you, Jane. Let us just see what the outcome of the last polling question was. Yeah. Okay, so I think that's a little bit in line what we said in the second, third round effects when Jane started to say it might be the war in Ukraine, Russia, and then it turns out what is the consequence of that, what is the next, what is causing what as a next step. Let's go for a final round before I open up the floor for questions from the audience, and I think turn to Clement again. You are now CEO of a relatively young supervisory authority, and you have taken a lot of steps recently to better capture and supervise financial stability risks. What is your takeaway, and what could you learn from the holistic framework in that context?
Thank you, Peter. I'm a very old supervisor managing a very young organization. That's certainly not the best match. But I'll be very brief. I think I summarized it in 2 words. I think it's clarity and momentum. Clarity because I talked earlier about all these alignment issues. I talk about the extra dimension. I think all the elements of the holistic framework provide us with a very, very clear mandate. And it's very transparent, and the industry is aware, and they're all aligned. I put an analogy, it's almost like, IIS build a house for me, and then I leave me with the interior design. So I do whatever I like within there, but I make sure that it's habitable, and I won't fall apart overnight. So that clarity is very important, particularly for us, because I mentioned earlier that I tend to build around what is being prescribed, and therefore I can address a bit of Dawn's answer about data, and also have a much better stability in terms of what I do with an organization. I do not have many people to spare. I do not want these people to get reassigned to duties against an already rather, shall I say, chaotic situation where we are trying to work on so many projects at the same time. Now, momentum. I think one element we haven't touched upon, Peter, is about implementation. You must be the one who really concerned about this as IAC chair. The TGA and BLA provides the momentum in a positive way. We like our regulated entities. We do not want more work, but we've got to make sure that at the same time they know why the work will bring them benefits. At the same time, we need to bring out the sticks and say, if you don't do it, something is going to happen. So the arrival of the IIS assessor created, shall I say, a lot of passive momentum. It's not active, but then I need to earn my ratings. So I will not leave anybody with any kind of idea that this kind of things is very easy to go by. We work our guts out doing this, and we are very concerned about what we ultimately are rated on. And Manuela, you know how much importance we place in this. And so I think that actually helps us because we're building. We've got to build the right thing, and we've got to build it in the right time, and we're going to build it at the lowest cost in terms of compliance for the insurance industry. Now, I just wish to conclude there's something which probably not entirely related, but to just capture on what Jane said, and I will finish after this. In the last couple of years, we had an unprecedented challenge, but it's also a very rewarding experience. And when we handle all these issues, I think there are three areas that it's very important. I wish you to take this when you go. Is that first, we are here as supervisors to protect policyholders, but there are different ways of protecting them. Prudential supervision is one way of protecting them, but allowing them to recognize the risk, the protection gap, and allowing them, like Jen said, to buy the right product at the right time, at the best convenience through the proper distribution channel is another way of protecting them. So supervisors will have to look at this from both angles. That brings me to the other two experience, which is to remain engaged with the industry. We do not have all the answer. Even I have the answer, sometimes I do not know how to execute them because I'm not at the market. I'm not really at the front line. So engagement with the industry about what to do, what can be done is important. And finally, remember always that whatever solution we have, market is the most powerful. Once you get the market to work for you, things will sort itself out. As regulators, we're not going into the market. We've got to make sure that the market functions the way we want it to, and therefore delivering the right product to people, which ultimately serves society and takes off fiscal burden from the government. I think that these are things I wish to leave you with when you go away from this panel. Thank you, Peter.
Thank you, Clement. I want to say, yes, I'm concerned as the IC chair about the implementation. But secondly, I'm excited, and I like to do that because I think proper implementation at the end only brings us closer to our mission and to our goals. Because, I mean, it's nice to read it there, and then you say, oh, you supervisor, you guys, you have all these standards on paper, and now the crisis happened, and what did you do, and so on. So really to make our systems much stronger. And that brings me to Andrew again. We are now in this process of implementation assessment, of implementation and implementation assessment of the holistic framework. And what do you see benefits and challenges in doing that, also from your jurisdictional perspective and the view we have on these macropotential issues?
You know, I think my very young colleague, Clement, actually addressed most of that. And I am going to echo what he said at the end, just in general, because what we're doing here in terms of reducing systemic risk helps the market open up. And when I talk to consumers or to various groups in the US, I always say, my charge is consumer protection, but that does not mean simply the company paying out whenever that fortuitous event happens. It means having the widest and most relevant array of products available to all. And that, in the end, is what we're working towards. You know, I tell, and you probably, some of you may have heard me say this before, I want insurance companies to make as much money as possible the right way, because that means that you're selling the products people want. product. And it is on us as regulators to make sure those products are safe and effective for our consumers. So I just want to echo that. I think it's something that we can never forget. The framework itself, the implementation, as you mentioned, I mean, it's happened during COVID. And so much has changed just for us. We work remotely for the most part now. There have been so many changes during COVID, and yet if you look, and by the way, we're part of that, just an aside here, part of the latest TJA, and I just want to thank the team because they are wonderful, and I love you all. Yeah, just to throw that out there. But you look at the compliance, the observance, and it really is stunning. I mean, you look at it and you think, how did so many people, so many jurisdictions manage to do this? Because as jurisdictions, funding may vary or resources may vary, but it is clear that the commitment did not. It is clear that this is a commitment that's widely shared. We can thank Peter and the IAC for doing so much, not just from the top down to say this is something you should do, but going out and encouraging various jurisdictions. And certainly, you've got a younger jurisdiction, I've got a slightly older jurisdiction in the U.S., but we're changing too. As we look at the framework, we look at what we're doing. We're changing our examiner's handbook. We're changing our analysis handbook. We're changing our ORSA, the Own Risk and Solvency Assessment, to better reflect the IAIGs. We're learning from the holistic framework as it's implemented. It's that there's a coordination that it provides, a certain standardization. We know what we expect from each other as supervisors, and that means for industry there is a consistency. You know what we expect from you, and you know what we should be doing. I think it just levels the playing field for everyone. It makes it easier that you don't have to deal with these conflicting requests from all over that sometimes could be contradictory. I know I'm a regulator and I've been on the other side. I think this is the holistic framework it's so far, I mean, I hate saying so many nice things, but it's been such a successful effort to standardize the way we as supervisors, as regulators operate. And I think it's been a great positive, both for the goal of reducing systemic risk and for making it easier for companies, for the industry to operate and to do what it does so well. Thanks, Peter.
Thank you. And now my final questions to Don and Jane. How are you, as from the industry side, noticing what is changing? Particularly, also Jane was referring to supervisory policy measures and this type of stuff, not only identification in your relevant jurisdiction.
You want to go first this time?
Yeah.
Oh, okay. Thanks, Peter. So, in Canada, we have a regime change at our prudential with our prudential regulator, and the new superintendent has talked about the need for a transformational change within the regulator, and public confidence is now public confidence in the financial system writ large is now their goal. That used to be a byproduct of everything they do, but now that has become their mantra, that everything they do has enhancing the public's confidence in our financial system as their number one priority. What they have said, at the beginning of this change is that the risks today are more volatile, they're more complex, they're interrelated, they're existential. Nothing that we haven't heard over the last day or so. So that's what's been said. What we've seen thus far, and this comes back, my comments about data and proportionality are, with my JAFIA hat on, but also with my Insurance Bureau of Canada hat on, because we're being absolutely swamped in Canada. So I apologize. I may put more emphasis on Canada than my JAFIA hat. I still appreciate Clement's comments about having heard the plea, but in Canada they're not hearing it, I can tell you. And the number of consultations, the depth and breadth of consultations is pretty incredible. The size of the organization is growing by 30+% over the next 18 to 24 months. So a regulator that's getting much, much larger in size, diving much deeper into a broader range of issues. Digitization, climate are two of their big risks. And we haven't seen the end result of this transformation and this bulking up, but early descriptors. There was one colleague in Canada who described it as the interaction with our regulator now is one of invasive intimacy, which I think is a rather interesting turn. We'll see how this plays out, but I think, Peter, it's in response to everything that we've been talking about here this morning and yesterday. You know, the level of risk, the nature of the risks are changing, the sophistication that's required to respond to them. And so our regulator in Canada is transforming, partly due to new management, if I could describe it that way, but I think a new world environment as well.
Thank you. Jane.
Thank you. I'll just add on a few things because, you know, as a company, we're part of the new regulation that Clement is talking about. And we're just going through now the first year, really the first official implementation of many of the things that we've been trying on a trial basis, or preliminary basis over the last few years. But I can say as a company, you know, we really commend the Hong Kong IA in the establishment of the group-wide supervision guidelines, because it's been very helpful for us as a company, but also as a company in the industry that we're in. And things like, you know, the ORSA and the recovery plan, those are very familiar to everyone else, but having those in place now officially within our group is very helpful. It's helpful to our board, it's helpful to our management, it's helpful to have the discussion with the regulator about things they think should be more prominent in the ORSA or should be less prominent. I think just that discussion is really, really important because none of us have all the answers when we look at risk. And then I think some of the other areas have been really helpful. We have a capital model that's promulgated by the IA. We have a LCSM method for calculating capital requirements. These have all been very helpful to us as a company, and we really appreciate actually the new regulation that we're under. I think it's, you know, it's still early days, so I think the most important thing, and the thing that's been so successful throughout this, is the amount of consultation that we've had between the industry and the IA for us. And I think that consultation is not always, you know, agreeing on everything, but the fact that we can discuss and really debate and model out some of the differences in opinions, I think is really the important thing in finding that kind of common ground that helps the business to thrive, but also helps, you know, all of you to do your jobs as supervisors. So I think, you know, we both have something we have to accomplish here, and I think really it's that open discussion that helps us to get there.
Thank you, Jane. We have now time for questions and comments from the audience, yeah? Oh, quite a lot. So I see you, I think, over there. It's difficult to see you, so please tell us who you are, because in the spotlight, you see us much better than we see you.
So Yoshi from OECD, just thank you so much for panelists and Peter. We have a very good view of this holistic framework, and it's very make world resilient. My question to you, panelists, and particularly Peter too, we have experienced global systemic, manifestation of global systemic risk 2007, 8, 9. And one of the surveys that you show indicate that, of course, macro holistic view is okay, but entity-based is sort of, both can create systemic risk manifestation. So my question to you is, even the holistic framework is so robust and comprehensive, is it sufficient? Is it sufficient to persuade FSB? And I have worked for FSB 15 years and Peter together. And my concern is once, as Jane, you mentioned, something bad happens, people are panicked. And it's not the normal interconnectedness. It's a very different situation. And you have discussed macro, or economic risk, cyber risk. And naturally, some financial transaction, their interconnectedness between financial institutions, insurance, including insurance entities. Of course, this holistic framework is robust, strong. But people might ask, is it enough? If some huge crisis occur, is it better to see entity approach too? I'm sure that this will be discussed in FSB, and I hope that you guys have a clear answer. But anyway, this is my question.
Thank you, Yoshi. Clement or Andrew, or should I say something? I would respond to say that's the best we can get for the time being. It is still it has an entity element in it, so we have an IAM in it, so it is not lost. But I'm fully convinced. I was a little bit skeptical at the very beginning how we can create a framework that is able to adapt to the risks, and we have heard risks are emerging even more and more quickly, and so we need to adapt. So we need to, I think, every year have the process of identifying, discussing, and talking about those risks. So I think the framework is now we are testing whether it's well implemented. I cannot think of what else. I mean, we need to develop it. That's my view. Do you have any?
I do agree. The framework will develop, it will evolve. But let's remember one thing, the prior focus on 9 entities, let's just say, since the G size, that was great for those particular entities, but what about the rest of the market? Okay, what the holistic framework offers is a look at what can actually cause change, because it's not going to be about what happened last time. The next crisis is going to be different. And what we need to look at are the activities that will most likely drive that next crisis. That's the flexibility that the holistic framework offers that the prior size, entity-based framework simply did not. I mean, it allows us to essentially go where the issues are, to find out what the real problems are, no matter the size of the company and no matter where they're beginning to manifest, and to address those as quickly as possible. I'm not on the FSB, I can't speak for the FSB, but I can say as an insurance regulator, I do find this a superior framework, and I find it superior because I think it is more effective.
Yep, very quickly.
I've told you guys that I'm an old regulator, so Yoshi, you should know that I was the insurance regulator from 2006 to 2009. That is the only 3 years I've been in supervision and left. But I've gone through the whole process. So my answer is, I do not know what is enough because we don't know what's coming our way. But this particular framework is definitely much, much better than what we had in 2008. I don't want to repeat all the things that we said, Peter, about the holistic framework, but one thing for sure is that the execution of any solution and the coordination about members of jurisdiction inside a region will be much better. The supervisory college provides us with a regular update, sometimes 3-4 times a year, on different aspects of preparation, things like recovery plan, things like CMGs, and things like regular change on different risk aspects. There are a lot of very transparent and candid discussions. There are sharing of data among insurers, and for an entity like Jane's, you are talking about 18 of them. I can tell you, Yoshi, in the middle of September of 2008, that morning, the only thing I did was to answer phone calls from all my counterparts in the region, asking for some money because they are all getting into panic about not being able to keep them companies solvent. So I think, and that single aspect alone, we're going to be in a much better position. As regards the view of FSB, I think Yoshi will know that we will be assessed it, But there are yardsticks, there are key attributes, so we've got to make sure that we fulfill the key attributes. That's a challenge, but that's something that internally we will have to achieve. Once we get that yardstick fulfilled, and then I think that we will be then able to convince the FSB that we are at least doing what is presently provided under the GSI regime. Thank you, Peter.
We can take one or two more questions. Yeah, one over there and the second one there. And then...
Thank you. Really briefly, Steve Brody from the American Property Casualty Insurance Association. We appreciate all of the work that you've done on the holistic framework. We've strongly supported it from the beginning. Appreciate the work that Commissioner Mays and others in the NAIC have done to implement it in the U.S. And just following on to the discussion we've just had, have you gotten to the point where you anticipate recommending to the FSB that the designation of global SIFIs be terminated? And if not, what more do you need to see as you continue looking at things in the assessment process?
Can we take maybe the other question as well and then sum up, because we are running late? Thank you, the gentleman over there.
Thank you very much for an interesting panel. I'm Callum Tanner with the Association of British Insurers. Firstly, I'd like to echo the comments in support of the holistic framework, which from our perspective is much improved from the GSI designation, so echo those comments. I noticed that at the start of the panel, no one chose liquidity risk as their top risk, and that reassures me from an industry perspective, because I think I would make the case that liquidity risk is low in insurance. We don't undertake maturity transformation in our products or investments like banks, for example. So, but I also know obviously that liquidity risk metrics are still under development as part of the holistic framework. So can I ask how the panel considers liquidity risk in the context of the holistic framework? Thank you.
Thank you. So who wants to start off on Clement? Oh.
Andy is beckoning me, so I go first. As I said, I do not want to steal the thunder of Dieter because he's working on the matrices. But one thing perhaps I just flag up is that one of the themes that we've been focusing on is private equity, alternative investment. If you go along that direction, in the past couple of years, we see a lot of incentives for insurers because of the low interest rate environment, moving on to alternative investments, some of which in fact are illiquid. So that is a trend of development which caught our attention. We are looking into it. We are going to place emphasis on the extra layer, the extra dimension that we talked about on this area. There are collaborations between regulators as well. For us, we have been discussing with NIC and BMA because a lot of our insurers and some private equity companies are rooted in these jurisdictions. So yes, we believe that liquidity risk is low at the moment, but it might not remain low. But I have to add that the interest rate environment is constantly evolving, but the trend of going into alternative investment with relatively less liquid characteristics will be an area to watch out for.
And Steve, first of all, I just want to say I love the beard. Is it? But I am going to let Peter answer your question on the FSB. In terms of liquidity, one of the things I mentioned that we're doing at the NAIC, and Clement just mentioned, at the NAIC we are doing significant liquidity stress testing for life insurers. And in addition, as Clement mentioned, we're working with other regulators, including Clement, Bermuda Monetary Authority, and others, because we want to make sure, the way we see it right now, the liquidity risk is low, but we want to make sure it remains low. And part of that is simply staying on top of things. And this is driven in part by the changes that have followed from the implementation of the holistic framework.
Thanks. Any comments, Don or Jane, you might make?
No.
Okay. Then I will include the response in my final remarks, because I think what I need to say is I like this panel. We experienced a lot of commonalities about saying that the holistic framework is certainly a major step forward in how we deal with risks and how we deal particularly also with defining what could be globally systemic risks that we need to cover. I think it is important to say that we are, and that's why I have the pleasure to chair this panel, because we are already in an implementation phase. So we have talked a lot about the HF, and there was a lot of, and it's still ongoing. Dieter might confirm that it's still a process that will not go away, because it's a process, not a framework, and that is the difference, by the way. We have no static kind of metrics that we apply, and then we say, look, that's the outcome, and then we can be satisfied, and then we apply measures. We might completely miss the real picture. And I think it is, of course, somewhat burdensome to refer to Don. We need data. We need, of course, to have information so that we have a clear picture on what it is. And I like the starting point when we talked about the risk. You had only the chance to tick one of those. And those here had the chance to explain why and what is the background of that. And that gave a specific nuance of all these risks. And that is exactly the value added that we can achieve. I believe that the holistic framework is not perfect, but we see it is well constructed. It is conceptually, I think, sound. And it turns out that, do not want to be too optimistic, but I expect a very good level of already implementation at this point in time when we go back to the FSB. The main thing, I've been in the FSB when I was the chair of the IS. I can tell you sometimes it's difficult to convince people, but it's better to convince people with something you are full in line with, and you are convinced that this is the right answer to that, and it's much, much better than what we had before, and certainly develop it further over time. But this is imminent in the system that it will develop. So many, many thanks to my panelists. It was great. Thank you for the questions, and thanks to the audience. I hope you enjoyed the panel, and we can conclude here.